Hi, welcome to my retirement roadmap. This is yet another session of my Roth conversion workshop. This is a series of videos to talk about Roth conversions. And again, just want to make sure that everyone understands this is education only. This is not specific tax advice. And if you do a Roth conversion, I strongly recommend you talk to a professional to make sure that it makes sense in your overall plan. Okay, this session here, I just wanted to talk about. I want to move clear to the end and bring it forward, and that's right here in this top here. When I talk, I've given 5 steps for a Roth conversion. These are, I think, about as high level as we can get for a Roth conversion. And each one of these steps can definitely involve a lot of work. But I just wanted to give everybody an idea of what is involved in a Roth conversion. Now, first of all, I will make a qualification here that this particular scenario is based on at least one of the spouses in a married filing jointly plan household is 63 or will be 63 by the end of 2025. Okay. That's what this is based on. So steps 1 and 2 are talking about that. And then if a person is single, then and they're 63 or over in 2025, that's where this comes into play. Okay, so step 1 is to estimate your modified adjusted gross income for IRMAA. IRMAA is the Medicare surcharge. Okay, and we could spend a whole hour talking about that. But income related monthly adjustment amount, and the more money you make, the more modified adjusted income you have, the more likely you may be impacted by IRMAA. Okay, so we've got to estimate this. And what that estimate is your adjusted gross income plus tax exempt interest. Now, this, for some people, this is really easy to get. You can start with last year's tax return and then make any adjustments. Start with last year's adjusted gross income. Do you have any tax exempt interest this year? And is anything changed from last year's adjusted gross income? So it can be that simple. And some people are, they do their own taxes, so you can go out and get your, I think they're pretty much out there now. The pre-tax season ones are available that you can start working it through your 2025 taxes. So that's one way of doing it. But you got to get this modified adjusted gross income. And then what you need to do is identify how much room that you have before you enter into an IRMAA bracket where you are going to get a surcharge. Now, these surcharges are not the end of the world, okay? The reason why I make a big deal about them is because if you like, I know this is the extreme example, but if you go over by $1 in your modified adjusted gross income, you're going to hit, you may get hit with, you will get hit with a surcharge, and that's a big price to pay for just going over by $1. But we're not going to stress over that too much, okay? But that's the idea, is we just want to know how close we are. The thing that makes it also tricky, I don't want to dive too deep on this, even though I'm tempted to do so, but we don't know what those brackets are going to be in 2027, because that's when we will get hit with the IRMAA surcharge. It's based, they look back 2 years. So 2025's income, the modified adjusted gross income, that's what they look at for 2027 surcharges. Okay, so it's basically, we're right kind of at the end of 2025. So we're really talking a year from now, maybe 13 months at this point. Okay, so that's what we're kind of planning on. And as of right now, I still don't think the 2026 brackets are out yet. So we're still left with 2025. But I think as we go along in the year, we'll have better information that'll give us a little bit better room, and then you kind of set a cushion as to how far you want to stay away from that IRMA bracket. That's the way I do it. Okay, then you want to also find out. I use step 3 is to determine where you're going to pay these income taxes from that are going to hit when you do the conversion. And again, we're not going to dive super deep into this, but if you don't have, if the household doesn't have any money to pay for the taxes on the conversion in a after tax account, like a brokerage account, all right, then it's the money to pay the taxes is also going to have to come out of the tax deferred account. And I don't think that's the end of the world. I mean, I've heard, over and over, you should never do a Roth conversion if you don't have the money to pay the taxes outside of your tax deferred account. And I agree with that if you're under 59 and a half. But in our scenario here, we got 63. Okay, so we're past that. Anyway, you got to determine where you're going to pay the income taxes from. That's step 3 there. Step 4 is to calculate the taxable income before the conversion. That right there is you just want to see how much you're going to need to pay and you look at it. We're really looking at the margin here, okay? And so really, when you're doing a conversion, you're not looking at your average tax rate, but if you most people can kind of be like in the 22-24% tax bracket, we could say. That's what you want to find out where you are. You get those numbers together, okay? Your IRMA impact that you might have, and then actually what the income taxes are going to be, and then you decide from a business, let's call it a business case perspective, is this really something that I want to do? And then step 5, of course, is to actually do the conversion. And there's a lot involved in making this all happen, but I did want to give the kind of the overall view of what happens in a Roth conversion. Thanks, and I look forward to recording the next video.